me quickly, without much delay, bring in Christy Mathai, who is the fund manager equity at Quantum Mutual Fund. Welcome. Let me quickly ask you as to how you're looking at valuations. Your larger view is that the valuations are not very far away from the median. But what's really changed versus the last 10 years is where we are seeing bond yields. The US 10-year average last 10 years yield was roughly at 2.2 odd percent, currently at 5%. How should one look at valuations in this context, in your view?
Right. Thanks for having me. So when we look at valuations in general, if you were to just divide it across the market caps and just talk about what's happening globally. So clearly in the past, let's say if you were to analyze the period from 2015 to 20 and the phase post-COVID when we had a sudden liquidity gush in the Indian equity markets, and all this primarily had to do with the global interest rates where they are. So that brought in a lot of money and liquidity, not in India, across the globe, a lot of markets. And what we are seeing is at global yields moving, as you said, about 5.5, near about 5%. We are seeing kind of a withdrawal in, some of these monies which has flowed into, emerging markets at large. And that's primarily due to the fact that if somebody sitting in US is getting, a USD return of close to 5, if you take some more risk, possibly much higher, then why would, they come to emerging markets? So that's a broader question one has to analyze. And within that, overall scheme of things, India clearly is, much better placed with respect to peers. So the withdrawal in that, so if you were to just look at India and compare it with most of the emerging markets, we clearly stand out on growth, though the valuations are a tad bit expensive. So if one were to allocate, to India or the broader emerging markets, so India from that perspective clearly stand out, but the risk of this, sort of FI money moving back because of higher bond yields is there, and we are kind of in that environment where this yields are probably going to remain. It can possibly move down a tad bit, but at least in the foreseeable future, near term, this yield is where it's going to be. So one has to contend with that risk. And if you were to put that on the backdrop of market caps, what we have happened and the historical valuations, the large caps by and large trade at, somewhere at 22 times price to earnings, very similar to its long-term medians. Though the composition might have changed, but you're also looking at fairly good growth. The mid and small has moved quite a bit, so we see some, outflow from that perspective. So that's where I would like to leave it at that. And so you have, but even in this market, you have significant opportunities if you were to pick the right spots, right?
Right. So what are the sectors pockets in terms of opportunities there?
Right. So we continue to find opportunities in the broader financials, with banks being the major component of that, allocation. We think if you were to just look at the current environment that most of the banks are in, it is a very benign credit cycle that we are currently in. So what we see, a lot of banks are, incrementally investing a lot in OPEX spend just to grow their branch network, spend on technology, and so on and so forth. But the growth is here to stay. Just the system growth, if you were to look at it, it's 15.5, 16%, which is fairly high compared to what we have seen in the pre-COVID days. So, and this growth, may moderate a bit, but it should remain in that sort of a range. And when we are looking at some of the issues with respect to NIMs, because the margins are contracting for some of the large banks, as we have seen in the results season or in the past one half of the year gone by, this would be a temporary sort of a hit if you were to really look at it, because last year we had a faster repricing of assets as opposed to liabilities, and now this year it's just reversing. So this should also stabilize maybe, in the next 6 months. And then probably we are looking at a reasonably good growth. The credit cost might inch up a bit, but net your PAT, growth is going to be quite good for banks. And the valuations, if you look at the entire, scheme of things, are quite reasonable within the large banks, especially the private space. So this is one of the major allocation for us. Incrementally, we are also very positive on autos in that sense, so that also we have larger allocation, mostly in the two-wheeler space, though we have a fairly good mix of, the premium end story where India kind of benefiting from the premiumization scheme. So that theme, we are exposed to that, but also we are very positive on the mass consumption, because if you were to just look at some of the valuations at which some of the two-wheeler companies trade at, especially exposed to the mass end, where the recovery is going to be much more gradual in nature. But if they were to come, so there's scope for significant re-rating in those pockets. And lastly, also we are also positive on IT, which is at the moment looks like a bit contra bet. Just looking at the first half results, seem like it's all gloom and doom. But we have to also understand the fact that some of these companies, most of the clients for some of these companies are, Fortune 500 companies who can possibly defer tech spends for quite some time, but they would not be indefinitely able to defer the tech spend because those are kind of central in nature to their survival in that sense. So, and the valuation in this pocket remains quite attractive in our view. So these are the three sectors broadly where we are quite overweight.
Yeah, right. Let me try and try and get you to elaborate a little bit more on IT. So with each passing quarter, it just seems that the pain will go away from IT, but that doesn't seem to be happening at a ground level. With every passing quarter, the pain just continues to remain. So when do you think the turnaround will happen? When do you see the light at the end of the tunnel? And what will be the factors that one should look out for if one were to look for that?
Yeah. So in terms of, how things can change, it's pretty difficult to guess, I guess, because, if you just talk to any IT company, they themselves have low clarity in that sense. So if you were to remember what happened post-COVID when there was sudden gush of a lot of orders that came in, so most of the IT services companies were caught off-handed, and then we saw the whole episode of, hiring, from campuses, laterally and so on and so forth. So even at inflection points in various cycles, even the IT services companies find it very difficult to predict where things will move. But if you were to just look at some of the indicators are coming through, some of the wage related issues are kind of sorting out. The attrition issue is kind of, coming down, and it has come down pretty sharply if you just see the past 2 quarter results. And some of the wage related headwind that some of the IT companies had are kind of going down. On demand, we see solid order books, TCV, which is just not translating to the annual contract value for the year. But this kind of lends some credibility to what will happen in terms of an FY25 growth, if you were to think about the IT services. So the larger TCV and some of the kind of deals that the Indian IT services are able to win, which it gives some sort of confidence in terms of when that recovery will happen. And by and large, we would have to let it play out gradually because it's kind of very difficult to predict that inflection points. But some of these headwinds in terms of, as I said, subcontracting cost, the margins, because of aggressive wage hikes and the big time hiring that they did, those are behind in terms of numbers. So we should see some margin improvement, as well as when the demand comes up, those things will look much better. So we'll have to wait out, and there is comfort of valuation at this point in time if you were to look at IT services in general.
Right, and very quickly, I'll stick with IT very quickly in just maybe 30 seconds. If you can tell us, large cap or mid small within IT.
Right. So we are staying put with large cap at the moment because we think the valuation is much comfortable in that place. The mid cap by and large, because they are just exposed to certain niche sort of sectors, and certain sectors could be at large. And if you have a tailwind in that, they tend to do better. But we broadly are sticking to the large cap universe at the moment. Yeah.
Right, and in consumer discretionary also very similar pain, but on the domestic side, right? Doesn't seem every single quarter we continues to feel that the recovery will come, not happening. What's your sense on that one? Because you're bullish on that as well.
Yeah, so I assume you're talking about the two-wheeler, the mass segment of the the two-wheeler space, which is kind of the growth is fairly muted in that sense. So here again, if you were to just look at the volume numbers, that have come through from a 20, and just compare it with what has happened from FY19 or before, the volume is way lower even from those levels. So at some point in time, the replacement demand has to kick in most of these pockets. And when you have that, you should see a volume uptick. And, it's probably a gradual increase that we will see, because the rural wage increases are kind of improving very gradually, as we are seeing. So part of this is clearly linked to what is happening, from the wages and so on and so forth in rural belt. So uh, we have to wait and watch. It's more a gradual increase that we are seeing. But by and large, if you were to look at some other pockets, domestically focused OEMs, so they are doing better. Probably the only issues with respect to exports, which also should come back in some time.
And Pharma is also one of your bets. Do you like more domestic facing? Are you looking at more of US? How should one look at it in your view?
Yeah, from a pharma space, I think our holdings have a mix of both, largely a US generic, and we also have a play in, the Indian markets through our allocations. So what you're seeing is the pricing the pricing erosion has kind of stabilized in most of the US generic market, if you were to look at it. And if you were to look at this numbers with respect to what has happened in FY23, where there was, the host of issues, be it pricing erosion, they were FDA inspection, which went wrong for majority of the players, and so on and so forth. So some of those things are kind of improving. And lastly, also on the input cost, that is also moderating. So from that point of view, US generic seems a better place at the moment. Though Indian market is extremely stable and reliable in terms of growth. You have IPM growth of around 8 to 10% on an average, and most of the pharma names kind of tend to grow just about that, and so on and so forth. So at the moment, we consider this pocket fairly valued. It is not as undervalued, let's say, if you were to look at the company's discretionary space. So, but we are kind of staying put with our allocations here.
Right. Thanks so much for that, Christy. Great perspective. Good chatting with you. But I'd like to quickly highlight to viewers, we had Canara Bank's results come in. We'll quickly flash that. It was flashing at the bottom of your screen. Good set of numbers coming in from Can Bank, especially on the NII front. And you can see the stock in recovery mode, up over 2.5% from the day's low. In fact, making almost a complete recovery. So that's what we're seeing on Can Bank. But let me slip into a very short break. We'll meet you on the other side, more on the other side.